Whether you're brand new to investing or not, the words index funds, mutual funds, and ETFs will definitely come off much more confusing than they need to be. In fact, I've seen all over the internet where this topic is not explained properly, and I even made the same mistake when I first started on YouTube. But after years of investing and heavily researching the markets, I've spent many hours specifically on this video to ensure that if you watch this until the end, I'm confident you'll understand the exact differences and similarities between each and how to approach them yourself. And all I ask is that if you do find value in this content, that you consider hitting the like and subscribe button for future content like this. With that said, the first thing that you have to understand that you may already know is that you can invest your money into a particular company by purchasing their stock, but the company has to be publicly traded on the market. Now, one of the simplest examples to use here is the company Apple, which is listed under the ticker symbol of AAPL. And let's say you love the company, you believe that their business is going to continue growing significantly over time, and you decide to put all your money into their stock. By doing so, you now have a chance to see a very high return with your investment, because if Apple were to continue doing very well, this could result in great returns for you as an investor. But by doing this, your portfolio now contains very high risk, because if Apple were to change products or somehow be severely impacted in a negative way, their stock could decline significantly, resulting in the worst nightmare you never would have even dreamed of. And so a quote I like to look at here from one of the best investors of all time, Ray Dalio, is when he said that diversifying well is the most important thing you need to do in order to invest well. And when it comes to investing, the goal is to maximize your returns, yet minimize the risk of losing money. So rather than going all in on a single stock or even a handful of your favorite ones that contain very high risk, to reduce that risk and still have the potential for strong returns on your investments, you could instead purchase an investment fund like one of the ones I'm about to mention in this video that would allow you to gain exposure to hundreds or even thousands of different investments all within one purchase. Think of it like this: when you go to buy groceries from the store, rather than spending $200 on orange juice, you would rather buy a variety of foods and drinks. And even more convenient, let's say that you bought 50 items, rather than having to pay 50 different times and getting 50 different receipts, you can put them all on one receipt, which means that you could buy all your groceries all within one purchase. Sound familiar? But let's say a few days after purchasing your groceries, you have an avocado that went bad, you would at least have plenty of other items that you could choose from. Now, I say all this because investment funds work relatively the same way, because rather than going all in on Apple stock, similar to spending $200 solely on orange juice, you would rather want a variety of investments so that you could reduce the risk on your hard-earned money. And with a fund like this, you can purchase many different investments all within one purchase, so say that one stock were to do poorly, then you would have many others that could balance out the portfolio. So when it comes to buying these funds I'm about to mention, understand that they can be targeted in many different ways that relate to stocks, bonds, real estate, commodities like gold or oil, crypto, the list literally goes on. But what's really important to understand is that funds like this, where you can gain a ton of exposure to different investments all within one purchase, they can be actively managed, which means that the fund is controlled by professionals that are real people that choose the investments in the fund. Or they are going to be passively managed, which means the fund is designed to automatically track a specific market index based on an algorithm. And so the key takeaway here is that any passively managed fund is considered an index fund because it automatically tracks a specific market index. To better understand this, let's first go over what exactly are index funds. Now, like I said, an index fund is a way to invest into a particular market segment all within one purchase. And so one of the most popular indexes out there that is considered the US stock market benchmark is the S&P 500, which is an index that tracks 500 of the largest publicly traded companies that are based in the United States. And I also have it on my wall that shows the history of it. And since 1957, the S&P 500 index has delivered an average annual return of just over 10%. Now, there are many other indexes out there like the Dow Jones Industrial Average or the Nasdaq Composite, but understand that these indexes, they don't just magically appear like something from Harry Houdini. In fact, there are actual companies called index providers that create and manage the indexes. So for the S&P 500, this index is overseen by the Standard & Poor's Dow Jones Indices, which is a division of the S&P Global Company. I mention this because in order to purchase an index like the S&P 500, you as an investor cannot buy it directly from the index provider, for this case the S&P Dow Jones Indices. You would actually have to purchase a fund that tracks the index, hence the name index fund. And so the companies that offer index funds, mutual funds, and ETFs, they're all considered asset management companies, And ones that you may have heard of consist of Fidelity, Vanguard, BlackRock, or Charles Schwab, to name a few. And from there, in order to purchase the investments they offer, you as the investor would need to place your money in a brokerage firm that allows you to invest into the particular investment that you want. Now, I know some of this may seem confusing, but as you continue watching, things should start to make much more sense. I say that because an index fund like the S&P 500 is considered a type of mutual fund or an ETF. I'll explain the differences between mutual funds and ETFs later in the video, but for now, just understand that if you have an account with Vanguard and you are investing on their platform, you have the choice to purchase an S&P 500 ETF that is traded under the ticker of VOO, or you could get a mutual fund version that is traded under the ticker of VFIAX. Both of these investments are considered index funds because they track an index, but to be even more exact with the terms, VOO would be an index ETF and VFIAX would be an index mutual fund. So an index fund simply means that your investment tracks an index, and if you're not sure whether it does or not, typically the name of the investment has index fund in the name like it does with VFIAX, or if it doesn't, like VOO, reading through the product summary, you will more than likely see it say that the fund indeed tracks the S&P 500 index. And because these two track the same index, the underlying holdings and overall performance is going to be relatively the same. But before I show you the top holdings that are in the S&P 500, understand that this index is considered a market cap weighted index, which means the companies that are in the fund are given weight based on their size. So if we look at the top 10 holdings that make up the S&P 500, as of the recording of this video, you can see that for VOO, Apple stock alone makes up roughly 7% of the entire fund, with Microsoft and Nvidia following thereafter at around 6%. This makes sense because if we look at the largest American companies by market cap, Apple is at the top with Microsoft and Nvidia thereafter. But knowing that if we compare this with the mutual fund version VFIAX, sometimes the numbers will vary slightly, but for this case, the underlying holdings have the exact same percentages as the ETF VOO. And for the expense ratio, which is how much it's going to cost you to own the fund per year, and also know that this cost is automatically going to be taken out of your investment over time, it's not something that you have to pay separately. But for VOO, the cost is 0.03%, and then for VFIAX, that is 0.04%. All that means is that if you had $10,000 invested in either of these funds, after a full year, it would cost you either $3 or $4, which is literally nothing. Where on the other end, an actively managed ETF that is controlled by professionals, they will typically charge much more for their work than a simple index fund that's passively managed. A simple example is a popular ETF that is actively managed by JP Morgan that has the ticker of JEPI, and this ETF has a 0.35% expense ratio. And if you want to confirm that the investment is in fact actively managed, if it doesn't say right away easily on the main page, looking at an investment's summary prospectus, it will cover many of the details you'd want to learn about the fund. So for JEPI, you can see the main investment strategies where the first two sentences tell you the objective of the fund is to seek current income while maintaining prospects for capital appreciation, and that the fund seeks to achieve this objective by creating an actively managed portfolio. Be aware though that most actively managed funds have over a 0.5% expense ratio, and Charles Schwab alone shows on their page the difference between their actively managed or passively managed funds differs from 0.76% of an expense to the index funds that are passively managed averaging 0.05%. So let's say that you have $2,000 to start investing and you add $500 every month into a fund that averages 10% per year, but it is actively managed and charges you 0.76% of an annual expense. If you do this for 30 years, your end portfolio would be $883,000, which sounds great, but $138,000 of that would have been lost because of fees. Or instead, if you use Charles Schwab's passively managed fund that averaged a 0.05% of an expense, assuming the returns stay the same, your end portfolio would instead be just over $1 million because the total cost of the fund ended up being below $10,000 as a whole, which is close to a $130,000 difference. And of course, the more you invest, the bigger the difference will be over time. And not just that, but the legendary investor Warren Buffett won a $1 million bet with hedge funds that the S&P 500 would outperform their actively managed funds. And if we look at the numbers, the majority didn't even come close to beating the S&P 500. So all in all, for index funds, I typically consider anything under 0.1% really low, and with the right ones, I strongly strongly believe that they are the best for long-term investing. And as far as the performance for the S&P 500 ETF VOO, looking at the past 5-year average, it has returned a 16.82% annual return, where VFIAX achieved a 16.81% return. Or if we look even further at the past 10-year average, VOO averaged a 12.93%, where VFIAX was 12.94%, so all the numbers are relatively the same. But just so you know, for future reference, the annual returns that you're going to see already include the expense ratio factored into it. But just to emphasize how strong of a market we've had, let's say that you had $100,000 of retirement savings invested in the S&P 500 without even adding more money into it. Over the past 10 years alone, that would have turned $100,000 into roughly $337,000. This is exactly why it's crucial to start investing as soon as you can and to continuously invest in the market, because without investing, the odds to retire financially free one day are extremely slim. So because you reduce risk by owning 500 companies, it's very cheap to own and has historically achieved very strong returns over time. This makes the S&P 500 among the easiest yet safest overall investments I believe is out there that nearly anyone can benefit from for solid growth over time. But to summarize the examples of VOO and VFIAX, understand that because they track the same index, the S&P 500, the results are extremely similar, and remember that both VOO and VFIAX are considered index funds because they track an index. Knowing that, the choice between investing in an ETF or a mutual fund comes down to the structure that suits you best, so let's now go over mutual funds versus ETFs. For starters, remember that mutual funds and ETFs can be either actively managed or passively managed, which if they are passively managed, they are considered an index fund, and to be even more specific, it would be either an index mutual fund or an index ETF. But no matter if it's actively managed or passively managed, the structure between ETFs and mutual funds do vary slightly, because with ETFs, they're more liquid because you can buy and sell them during market hours at any time, similar to trading any ordinary stock. So if I look up an ETF like VOO, you will see the prices constantly fluctuate throughout the day, and if the market is open, you could place a market order to execute right then and there. But with mutual funds, they are less liquid because the trades only go through at the end of the market day. This is because mutual funds are priced based on their net asset value, their NAV, which is calculated once at the end of the day when the market closes, based on the value of all the underlying holdings that are inside of the fund. Because of that, if we look at VFIAX, the prices shown on the stock chart only come up once per day, rather than VOO that was constantly changing throughout the day. So if we were to put in a market order to purchase VFIAX at 10 a.m. Eastern Time, the trade would not go through until the end of the market day. Because of this difference, ETFs have what's called a bid-ask spread that shows the difference between the price a buyer is willing to pay for the shares, it's called the bid, and then the price a seller is willing to sell the shares for, the ask. So this can result in an ETF to trade slightly above or below the true net asset value. So to sum this up, just understand that with ETFs, the prices change throughout the day, where mutual funds just settle with a single price at the end of the day. Besides that, ETFs have no account minimums to invest, where depending on your broker, with mutual funds, a minimum investment may be required, which could be thousands of dollars, like Vanguard's, that is at least $3,000 to get started. On top of that, you can purchase ETFs on nearly any platform, similar to trading stocks, but with mutual funds, typically you can only purchase them through the provider that issues them, unless you pay an unnecessary fee like buying a Vanguard mutual fund through Fidelity cost $100 per transaction, which there's no reason you'd ever want to do that. Another difference that makes it easier to tell the difference between an ETF and mutual fund is that ETFs typically have 3 to 4 letters in their ticker symbol, so an example with 3 letters in the ticker symbol that is also an index ETF could be VOO, and then one with 4 letters that is actually an active ETF that I mentioned earlier could be JEPI, where for a mutual fund, they typically have 5 letters in their ticker symbol, which an example could be VFIAX. Besides that, another topic between ETFs and mutual funds is that ETFs are known to be more tax efficient than mutual funds. This in fact is true, but it really only matters if you own actively managed funds with high turnover rates, which means that the fund managers are changing the positions often, and that could cause capital gains to be triggered even if you don't sell the fund yourself. Where with ETFs, aside from dividends, you generally have full control over when to trigger capital gains, as they are only realized when you sell your shares. Not to get carried away, but this is really important to understand because in 2021, Vanguard created big tax bills for target date fund investors because they heavily changed positions in their funds, which triggered thousands of dollars in surprise tax bills to those that owned them in taxable accounts, even if they didn't sell the fund themselves. Where for those who had them in tax-advantaged accounts like the 401k or IRAs, they did not face the same tax consequences. As you can see, obvious examples that are ideal to avoid in taxable accounts are REITs, high turnover active funds, and high yield bonds, to name a few. And although I personally like to keep all my mutual funds solely in tax-advantaged accounts, if you do have index mutual funds like these in taxable accounts, by no means do I think it's worth switching and triggering capital gains. But please understand that you have to make your own financial decisions. I'm just doing my best to provide the most accurate information possible to help you learn the differences and improve your knowledge. Which, if you are finding value in this content, I would really appreciate it if you do hit the like and subscribe button with notifications on for future content like this. But before we continue on to the last section of this video, understand that in the most recent years, the creation of new ETFs has risen significantly compared to mutual funds that have actually declined. And although both are still increasing rapidly in their total net value, actively managed ETFs specifically have gained significant traction recently, and I wouldn't be surprised to see their growth continue as their tax efficiency gives investors more control over the taxes and is especially attractive in taxable accounts. But to finish this comparison, to summarize the similarities that mutual funds and ETFs have is that they can both provide broad diversification, they can be actively or passively managed, they both have costs that are called expense ratios, and most offer automatic investing features and the ability to buy fractional shares depending on the platform you invest on. Which, fun fact, but just recently, Vanguard posted that effective January 2025, that you can set up automatic investments into your Vanguard ETF positions. And not to mention, but one unique tool that I know at least Fidelity offers with mutual funds is that I could direct the dividends from any of my mutual funds to be deposited directly into a different mutual fund. So if I wanted my S&P 500 dividends to be directed to my large cap growth fund, I very well could do so. But knowing all that, let's now go over which one is right for you. For starters, if you are investing on a platform that doesn't offer mutual funds or even that great of options, you may very well want to go with ETFs because you can trade them on nearly any platform and the results are going to be extremely similar. Or let's say that you are looking to actively day trade or even trade options, you will have to use ETFs because you can't do either with mutual funds. Something important to also know is that one of the most actively traded ETFs is the S&P 500 ETF with the ticker SPY that has roughly $620 billion in assets under management, and so many investors are actively trading this ETF because over the past 30 days, it is shown to have a bid-ask spread of 0% because there is so much supply and demand from both sides of investors. Now, if you're a long-term investor not actively trading, this ETF is not recommended in my books because the expense ratio is 0.0945%, where State Street intentionally created a different S&P 500 ETF with the ticker of SPLG specifically to be a cheaper alternative for long-term investors, where this ETF has a 0.02% expense ratio. But besides that, another time that you may choose ETFs is if you are unable to buy a mutual fund due to minimum required amounts. For example, if you're on Vanguard, you need at least $3,000 for their mutual funds, but $0 for their ETFs. Depending on your broker, this may not matter because if you're trading on Fidelity, they don't have any required minimums on their mutual funds. Which, fun fact about Fidelity is that they even have a few in-house zero-fee index mutual funds, which I made an entire video on. If you want to learn more, I'll have it linked in the description below. And just so you know, I'll also leave other relevant videos I created that I think you'll greatly benefit from linked in the description below of this video and of every video that I create. Besides that, remember that if you are buying actively managed funds with high turnover rates in taxable accounts, you would be much safer to use ETFs instead. But as a whole, if you are investing for the long term with index funds, mutual funds may be psychologically more beneficial for you because they may reduce the urge for you to want to sell your investments, which would help you focus on dollar cost averaging, which means to continually invest over time, because with the right investments, that has proven to do extremely well for investors. Now, this definitely comes down to a personal choice on whether or not you find an ETF or mutual fund version that you like better, that also suits your brokerage and the type of account that you're investing in. But if you are curious about the approach that I take, I personally like to keep things simple and use mutual funds in my tax advantaged accounts like the Roth IRA, and then ETFs in all of my taxable accounts. Which, which if you are interested to see exactly how I allocate each of my investments and other exclusive content, consider checking out my Patreon linked in the description below. Besides that, if you want to learn more about building an investment portfolio or my entire index fund cheat sheet, all of those and many other free learning guides I've created linked in the description below for you. And while you're at it, if you want to get started with investing, I'll also have a link to some of the top investing platforms available in the market, which I will say, depending on the one that you choose, I may earn a commission for it, which is greatly appreciated. Thank you all for watching. Let me know any questions in the comments below, and as always, don't forget to hit the like, subscribe, and notifications button for future content like this.